This is Jensen Huang, one of the richest people in the world. His wealth is estimated at 117 billion. He's the CEO of Nvidia, a company known for designing GPUs used for AI, gaming, and technology. The stock has been all over the news with its massive bull run due to the AI revolution. The stock increased 300,000% since the IPO. He owns 860 million of these shares, and this is where his wealth is. So how is the co-founder avoiding billions of taxes? First, we need to understand how estate taxes work. When you pass away, your estate might be subject to an estate tax. This tax applies to everything you own, including cash, stocks, real estate, and other assets based on their fair market value. In 2024, each taxpayer receives an estate exemption of 13 million. Beyond that amount, the estate can be taxed at a rate of 40%. Let me give you a simple example. Say you pass away and leave $10 million to your heirs. Since it's less than the 13 million exemption, you pay no estate taxes. But what if you had 100 million? Or 100 billion, you would pay a 40% federal tax rate beyond the exemption amount. Wealthy individuals like Jensen Huang often use creative strategies to reduce this tax burden. In 2012, Jensen Huang created an Irrevocable Trust. This type of trust allows you to transfer assets out of your personal estate into a trust so that the trust effectively owns those assets. One of the advantages is that the creditors cannot sue for assets held in this type of trust because the grantor no longer owns them. But the biggest advantage is that the trust assets are shielded from estate taxes. So what did Jensen do? On December 28, 2012, he transferred 584,000 shares that he owned personally to the trust based on the SEC filing he was required to file. These shares were valued at 6.5 million at the time. Gifts beyond an annual limit reduced the estate tax exemption I talked about before. So this transfer was subject to a small amount of gift tax as the exemption amount was 5.1 million in 2012. Today, after accounting for stock splits, those Nvidia shares are worth an estimated 3.3 billion and are inside the trust. Now, if he didn't use the irrevocable trust tax planning strategy, he would have faced $1.3 billion of estate tax upon his passing. By contrast, this strategy reduces the tax bill to a few hundred thousand, saving $1 billion in estate taxes. However, he didn't stop there. According to the SEC filing, he further diversified his gift and estate tax strategy by establishing a grantor retained annuity trust, also called GRAT, and transferred 3 million shares into it. Currently, the trust owned roughly 59 million shares due to the stock splits within the GRAT, which are now worth around $8.5 billion. So what's the main benefit of GRATs and how is he avoiding estate taxes? A GRAT freezes a portion of estate's value at today's value while shifting any future appreciation of assets to beneficiaries free of estate and gift taxes. Any assets passed to heirs would be free of gift and estate taxes, avoiding 3.5 billion in taxes if he did not create this trust. Now, this is just what we see based on the SEC filings. He could also be using more sophisticated strategy to further lower his income taxes, not just estate taxes. For example, he could be borrowing against the trust assets using a personal guarantee, where the trust pays a small guarantee fee to Jensen funded by dividends from Nvidia shares. The loan is not taxable income, which means you pay no taxes on it. This would allow him for a small fee to obtain necessary liquidity for his day-to-day expenses. Before passing away, he will likely exercise the power of substitution, where he will swap cash into the trust in exchange for interest in the assets. In simple words, he will put cash and take away these Nvidia shares. Why? Because then it would allow his beneficiaries to receive these shares, get the step-up basis adjustment to the fair market value, and pay $0 in income taxes when they ultimately sell these shares. This strategy is commonly referred to as buy, borrow, die. There are also even more sophisticated strategies related to installment sales that are beyond the scope of this video. So these strategies not only allow Jensen Huang to avoid estate taxes, but also income taxes. Is this all legal? Yes. The courts had an opportunity to stop this, but they didn't, specifically in Walton versus Commissioner tax case. In 2010, the Treasury Department tried to make it harder to avoid the estate tax by proposing restrictions on the use of GRATs, but it didn't go anywhere. If you enjoyed this video and learned something new today, I would really appreciate it if you can subscribe. I'm almost at 1,000 subscribers, so I would really appreciate your support.